startup team consider as they approach their first set of financial projections?
So one of the things that I see from a lot of companies that are just starting out is actually they actually don't even have financial projections. So, it's I believe one of the first things that's to actually be done is before you even start the idea is to actually even do a simple financial projection, even at its basic level. And then that can grow over time as you get more market validation and add more complexity. But I think it's really important to at least start off and test whether there's actually a financial viable business. And that's the goal at the very, very beginning. You don't have to get into detailed balance sheet projections or income statement. This is just straight cash flow that has a simple revenue line, your expense lines, contingency to give you a total amount of cash that needs to be raised to actually get you to revenue. Okay. Now, when you're building the financial model, one of the most important things that investors are going to want to see when you're raising money is that you actually have put some thought into your assumptions. So when you're looking at your revenue line and your revenue assumptions, you're going to want to build a separate tab, document all the different assumptions. So for example, your pricing. Here's what the pricing is. You've gone out to the market, you've validated it against other similar products. You have some rationale of why you think that pricing is actually the right way to go. How fast are you going to get into the market? Attach it to the size of the market. Here's how we're going to actually sell these products, the rate we're going to sell. So you want to document all those assumptions and build a case. So when you actually go out into your market validation, you can actually start testing that as part of your market validation. Same thing for expenses, right? Go out, build all the different expenses that you want to do. Now I like actually putting the expenses into two different buckets. The first bucket is your startup costs. Here's the timing and the startup costs of what it's going to take to actually get to your minimum viable product. And then the financial model goes from there. This is how long it's going to take to actually test it and get to positive revenue. So I sort of break up my expenses into two different buckets. And then you want to test all your assumptions on your expenses. You want to build them up. Here's the amount of, for example, a salary line. Here's how many employees we're going to have. Here's how many. Here's what we're going to pay them, right? Here's how many hours they're going to work. And you want to build up this model. So an investor really wants to see that you've actually put some thought into every single line item, that you have some rationale of why it's going to be that cost, and that you've just done some thinking around it. And at this stage, you don't know. It really is a hypothesis of what you think the business will be, and it will change, without a doubt. The one thing you can be sure of is that the first financial model will be absolutely wrong, and it will be changing as an evolution, and it's something that you should always be building on.
Do you look at scenarios, worst case, best case, possible strategies?
So we do a lot of, once you have your basic financial model done, you start doing some sensitivity analysis. And this is where you're looking at testing your assumptions and seeing how the model, where the model breaks from a business point of view, for example. So if my pricing is $20 per unit, what happens to the model if I can only get $10 per unit or $5 per unit? And you start doing some sensitivity analysis on a worst case basis. But on the alternative side, you also do it from a best case. What if I can get 30 and 40? And just do some of that thinking. And what an investor will look at is go, okay, how much money are you raising? Okay, how much money do you need to get through? And if it's a worst case model, does this business still work? And is it still going to be profitable? And have you raised enough money to get through to that end goal on the worst case basis? That being said, you're going to raise your money, and there's a lot of, I get asked this question a lot, is which performer should you actually put in your pitch deck? I believe you put in the one that you really think you can achieve. Right, you're not going to put in your worst case and everything. That's stuff for to do on a due diligence side, and just let them know that you've actually done the thinking. But what you want to present is what you realistically think you can do and what this business is going to be, and that's really what you want to model.
Don't you find that many businesses are too optimistic and they don't therefore raise enough money, especially if the fundraising is based on hitting certain milestones and...
Exactly. That's why you raise the money based on the worst case, but you present, you value the company based on what you think you're going to do. And they want to, and investors want to see, and that's really where that contingency line comes in. When you do your sensitivity analysis, do the worst case, and then sit there and go, okay, like if it's the worst case, we're going to need an extra $10,000 to get us through to positive revenue. Then that's how you justify the contingency line in the financial pro forma.
Perfect. What time frame should the teams be looking at as they develop their projections?
It really depends on the business. I've come from a lot of capital-intensive businesses that would be $30 million, $40 million power projects, for example. That was my last business, and we were running 5 years because between the construction, the development, the permitting, everything to the getting through to the positive revenue, it was a 5-year period. That being said, when you get into more of an app type business or maybe some software, they can be much more shorter term. But definitely you have to have a projection through the development phase, and then you want to have it through to where you have positive revenue. I like to see minimum 5 years, to be honest, detail monthly for the first 2 years, and then you can just do an annual projection after that.
Often you'll change that projection countless times, but it shows that you're thinking and strategizing as you sit down with potential funders. So can you give us some rules of thumb on what funders are looking for, how they view a business and how they view the projections in terms of it being an attractive business, what size of business is an attractive investment, what grant funders might be looking at as they look at the numbers? Okay.
Yeah, every industry has their own rule of thumbs. And like if you're in a manufacturing business, they're going to be looking at what's your cost of goods sold, what's your gross margin. If you're looking at a SaaS business, they're going to be looking at your retention rates, what's your lifetime value of that client, what's your acquisition cost. So there are some different rule of thumbs for every single industry. It's one thing you can actually go on the internet and you can actually find a lot of the rule of thumbs and what the industry is looking for based on what your business is.
But I actually loved what you were just talking about, and I think it applies to a number of the teams here, that the idea of a lifetime value of a customer, the ability to sell into the same customer over a long period of time, or to sell additional sell replacement parts or additional services or support services to that customer versus going out and acquiring new customers. Can you talk a little bit about that?
Sure. So in a SaaS business, one of the ways the industry and the investors are looking at it is your cost of acquisition of that customer. Let's say it's $5 advertising for every customer that you're acquiring. And is that and then they look at the retention rate of that customer. So is there a drop off, or does that customer stay on? It's like the stickiness of the customer. Are they there for 5 years, 6 years? That actually, the more stickiness you have with that customer, the longer that customer stays on after you've acquired that customer, the higher the valuation that you're going to get. So there's a whole analysis. It's actually almost its own mini financial analysis around what that value of a customer is. So it's going to look at cost of acquisition, how long does it stay, how much additional revenue does that customer buy off you on an annual basis, and on length of time. And then they do a net present value discounting of that to basically say, okay, X customer costs you $5, it's worth $60. So for every customer you're adding now, they times it by that multiple of the LTV, $60, and you get to a valuation of the company. Yeah.
So a company, for example, in ag tech that is forming a relationship with a farmer or a grower, and that relationship is going to extend on into the future, or a company selling in sensors and cloud and artificial intelligence to the vehicle market, is going to have long-term customers. And
my last business was we were actually signing 20-year agreements, and so we were getting 20-year LTV on every single customer. So it was just a huge multiple for every single customer that we added.
Great, thank you. On the grant side, what have you found in working with the Accelerate Okanagan Ventures in particular that grant funders like an IRAP, for example, or a MITAX might look at as they evaluate whether the company has the right kind of financials to invest?
Yep, they're going. A lot of the granting companies are looking for exactly the elements we've talked about. Right, they're going to want to see a solid business plan. They're going to see that you've done some detailed assumptions, and they're going to want to see a projected financial model that gets theoretically gets you to a profitable business. Like they're wanting to invest in companies that are real companies. So they're going to want you to spell that out for them and to show them that you can actually get there. Then there's a lot of other intangible things attached to it. Like they want to see that there's job creations, for example. Like they have some different criteria.
Benefits to the community.
Exactly. Yeah.
Jobs created in the region, economic benefit in terms of acquiring service providers, providing service providers or consultants, business, etc. One of the challenges the teams have is, as they go through the customer discovery process, is defining the total addressable market that they're going after, and then trying to define what's realistic as a achievable market penetration goal, and then quantifying that. Could you talk a little bit about how you approach that challenge?
Sure. I'll start off with what I think is one of the mistakes a lot of people make. I see a lot of companies come in and go, oh, it's $1 billion business, and if I just get 1% of this business, we're going to be X in sales. Don't do that. That's what everyone does, and that's not how it works. They want to see that as a huge market. So you do need to just state, look, it's a $1 billion addressable market, and then if you're going after a niche play, break it down into the size of the niche. And base that off of third-party market data that you find and you've researched. But when it comes to actually, so that's the first step. So you basically said, okay, so now you know there's an addressable market. Then what you want to say is, separate the market penetration of going, this is how we're actually going to go to the market. We're going to make 10 cold calls per day. Out of that 10 cold calls, we already know that we're going to get one customer proposal. Out of every customer proposal, we know we're going to get 10% of them in business. Like if you start actually spelling it from a point of view of actually the tasks you're going to do and how you're actually going to get to market, how you're going to do your marketing, how you're going to do your social media, how you're, build the plan around how you're going to go to market. That's what they want to see. They want to see that you can execute. And that will put you in the top 10% of most entrepreneurs that I see if you actually approach it that way.
So this is really a part of your customer discovery, a continuing part of your customer discovery process, because you can test these assumptions both in terms of talking to companies that are in the same space or dealing with the same customer. You can find out from them how difficult it's been to land customers, what kinds of touches, and what the sales cycle has been to close a deal. And you can also test assumptions in terms of what other companies, other startups in a similar space have been able to achieve over similar timeframes. So first you're asking questions to determine what your product is. At this point, you're now starting to push on your assumptions to test those out. Your mentors also have a great deal of business experience, and this is a great question to ask them. Are you overshooting? Is it realistic? Are the timeframes you're looking at and the projections realistic? And they'll be able to give you some good sound feedback as well. And if you need additional resources that are specific to your business, we can find a mentor to help you with that process. In terms of liquidity events, can you describe how you look at those and what investors look for, and how you manage that piece of the planning process?
Yeah, and some of that's probably a whole separate session when you get into like valuations and cap tables, share value, in multiple exits, all that sort of stuff. So I'm not going to get into the real detail there, but at a minimum, you have to show an investor how he's going to make money. Okay, so you're asking for $10,000 from this investor, and he's coming in within a time period. What I like to do is a little bit of a matrix going. And this comes back to the sensitivity analysis. If we do the base case in 4 years, you have a possible exit return of, let's say, 5x. If we exceed that on my high case, it could be a 10x, and on our worst case, you're still going to get a 2x. Right? So I like to do a little bit of and show it to the investor exactly how you think they're going to make money, the time frame of where they're going to make that money, and just some variance in the range on it.
When you're demonstrating your projections and developing them, how do you get access to competitor data, and how do you depict it in your presentation of the financial projections?
Yeah. So I depict it inside on the assumption side. I basically list the references, everything. Public companies are a great place to go. It's all their data's there. They're showing exactly their expense lines, the percentage, what they're spending on marketing, cost of goods sold. There is a lot of startup companies. If you go down to the OTC, the smaller trading accounts and stuff, from a public point of view. Another thing is just basic competitive research. Pick up the phone the competitor. You wouldn't believe how many will give them their the pricing lists or their product brochures and everything.
And I think we've talked about before the advantage you have being part of the university, whether you're a student or faculty. People really want to help students, and they like to help research projects, and they're willing to give you a lot of information that they might not give someone out in the private sector. So this is the time to take advantage of that. There are so many topics in this wheelhouse, and we can't cover them all in this session, but is there, before I open it up to questions, are there some other thoughts that you'd like to share with the group?
Sure. Partner up with finance guys, accountants. Bring in, like, if you're finding this overwhelming, and I can tell you right now, as this grows, these models get very, very complex. So bringing in the skill set, partnering up with the skill set, people in the university here that are actually wanting to do this sort of thing, it's a good way to work with people that really want to do this, and also to gain your skills at the same time.